Let's be real, the 2026 market looks absolutely insane. With all the crazy rate hikes and drama, who doesn't want their money to be safe? But people are spreading this massive lie that you have to pay a fortune for safety. You have these so-called experts pushing funds with huge fees, acting like they have some secret password to protect your money. That is 100% not true. What if I told you the absolute safest investments on the planet are also the cheapest you can possibly find? I'm talking about a few incredible exchange-traded funds, ETFs, with fees as low as 0.03% to 0.08%. That means for every $10,000 you invest, you could be paying just $3 a year. This isn't gambling. These funds are built on two things that basically scream stability: dividends that never stop growing and insane amounts of free cash flow. In this video, I'm going to show you exactly which ETFs these are, how they work, and why they are built like a fortress for the year ahead. But wait, before I give you the tickers, we need to agree on what safe actually means. Safety in investing doesn't mean you have zero risk. That's impossible. We're talking about building a portfolio that is designed to survive the market's craziest mood swings. We're not running from the market, we're just being smarter than it. So what makes an ETF safe for 2026? It's actually super simple. First, you need insane diversification. You want funds that don't put everything on one bet. Instead of gambling on a few tech stocks, these ETFs own hundreds, sometimes thousands of companies in every industry you can think of. That immediately crushes the risk of one company tanking your entire portfolio. There's a reason the living legend Warren Buffett has been screaming for years that a cheap S&P 500 fund is the best move for almost everyone. Second, and this is huge, we are hunting for companies that are, when a company has raised its dividend for 10 or even 20 years straight, it's sending you a massive signal. It's telling you its finances are rock solid and it actually cares about paying you. These aren't some weird profitless startups, they're giant, blue-chip businesses. This is the main strategy for funds like the Vanguard Dividend Appreciation ETF, VIGI, and the Schwab US Dividend Equity ETF, SCHD. Third, you want to see monstrous free cash flow. Free cash flow is the cash a company has left after it pays all its bills. It's the lifeblood that pays for dividends, buybacks, and future growth. ETFs that find these companies are basically targeting businesses that are literal cash printing machines. That means their dividends are way more secure, even if the economy completely nosedives. And finally, the ultimate cheat code for safety, an ultra-low expense ratio. This is the tiny fee you pay every year. It seems small, but it will destroy your returns over time. An ETF that charges 0.08% lets you keep $99.92 of every $100 you make. A fund that charges 1% takes a whole dollar. Over a few decades, that difference is gigantic. The single best way to predict how a fund will do in the future isn't some secret formula, it's low fees. Now let's see the ETFs that absolutely master these rules. First, we have to build an unbreakable foundation for your portfolio. These are the funds you can buy and literally forget about, and they give you the entire market for an unbelievably low price. The undisputed champion is the Vanguard S&P 500 ETF, ticker symbol VOO. This ETF just copies the S&P 500, so you instantly own a piece of 500 of the biggest, most powerful companies in the United States. The expense ratio for VOO is an insane 0.03%. No, you did not read that wrong. That is $3 a year for every $10,000 you invest. It's one of the biggest and most trusted funds on earth for a reason. It gives you unbelievable diversification from tech to healthcare, making it the perfect core for anyone's portfolio. But what if you want to go global for even more safety? For that, an amazing choice is the iShares Core FTSE 100 UCITS ETF with the ticker ISF or CUKX. This ETF tracks the 100 biggest companies on the London Stock Exchange. These are giant stable companies in industries like finance and energy. The expense ratio is just 0.07%, which is crazy cheap. If you get the accumulating version, it automatically reinvests your dividends to compound your money without you doing a single thing. It's a perfect partner to a US fund like VOO and helps protect you from currency swings. These two ETFs are proof you do not need to pay a ton of money for massive, stable market exposure. They're the literal building blocks of a portfolio that can survive anything. Hey, if you're getting any value out of this and want to learn more secrets to building a cheap, powerful portfolio, do me a favor and smash that subscribe button. I drop videos like this every week to give you real data-driven advice. And comment below, what's the highest, most insane expense ratio you've ever seen? I'm going to read all the comments. Also, kindly hype this video up. Let's try to make it to the top of the list. Okay, let's add another layer of armor to our portfolio with ETFs that are obsessed with dividends. We're talking about the dividend aristocrats, companies that have not just paid, but increased their dividends every single year for decades. A complete monster in this category is the SPDR S&P Dividend ETF, ticker SDY. This ETF strategy is genius. It tracks companies that have raised their dividend for at least 20 consecutive years. 20 years straight. These companies have survived recessions, market crashes, and total chaos, and through all of it, they kept giving their shareholders a raise. That is the definition of financial power. This fund is spread out across a ton of different sectors, and it's built so you're not risking it all on one stock. The expense ratio is 0.35%, which is higher than the others, but what you're buying is a historically bulletproof dividend strategy. For anyone who gets nervous when the market swings, the track record of these companies is a massive financial shield. A dividend history is amazing, but it's looking at the past. To see what's going to be stable in the future, we have to follow the cash. That brings us to our next group of safe ETFs, the cash flow kings. These funds hunt for companies that are generating insane amounts of cash. One of the most popular ETFs on the planet is the Schwab US Dividend Equity ETF, ticker SCHD. People love this ETF for a simple reason. Its strategy is brilliant. It looks for companies that have paid dividends for 10 years straight. Then, it filters them for things like cash flow to debt and return on equity. What you get is a list of about 100 of the most financially solid, highest quality stocks in America. Because it focuses on companies that are swimming in cash, SCHD gives you a great dividend yield and dividend growth. With an expense ratio of just 0.06%, it's an incredibly cheap way to own a portfolio of high-quality companies. It's packed with stable sectors, like healthcare and financials, making it way less volatile than the rest of the market. When other investors are panicking and looking for safety, an ETF like SCHD, built on real cash, looks like a genius move. Another unbelievable choice, with an even bigger focus on buy, is the Vanguard Dividend Appreciation ETF, or VIG. VIG tracks U.S. stocks that have increased their dividends for at least 10 years in a row. This ETF is less about how much it pays you today, and more about how much that payout grows over time. That is a powerful engine for long-term investors. VIG has a mind-blowingly low expense ratio of 0.04% to 0.06%. For just $4 to $6 per $10,000 invested, VIG gives you a disciplined way to own America's most durable companies. So, what's the big lesson here? In a crazy 2026 market, you don't have to pay a fortune for safety. In fact, the strongest, most stable portfolios are built with ultra-low-cost ETFs. We started with the core foundation like VOO, which gives you the entire US market for a tiny 0.03% fee, and ISF-CUKX, which adds that global exposure for just 0.07%. That is your base. Then, we stack the dividend growers on top. We looked at SDY, which focuses on the elite dividend aristocrats with over 20 straight years of dividend hikes. Finally, we found the cash flow kings, SCHD and VEG, which find financially unstoppable companies that are gushing cash and growing their dividends, all for just 0.06% and 0.04% in fees. Building a truly safe portfolio isn't about timing the market or finding some secret overpriced fund. It's about being disciplined. It's about diversification, owning quality companies, and, most importantly, keeping your costs as low as humanly possible. These ETFs are proof that you can get maximum stability without giving all your money away in fees. Thanks for watching. If this video helped you think differently about how to invest safely, destroy that thumbs up button and subscribe for more content, just like this. I'll see you in the next one.